All right, let's talk about something that sounds super complicated: liquidity management. It's one of those big, scary banking terms. But what if I told you it's actually something you totally understood back when you were like 10 years old? Yeah, really. Let's get into it.
I'm serious. Think about it for a second. That classic summer business, the lemonade stand, it holds the secret decoder ring to understanding how the world's biggest banks stay in business. This is where it all starts.
You know the drill, right? You buy your stuff, lemons, sugar, you mix it up, make the goods, you sell it for cash, and then, and this is the most important part, you take that cash and buy more lemons to keep the whole cycle going. That flow of money is literally everything. And boom, right there, that's liquidity. It's not about how much lemonade you have stashed in the fridge. It's about having that cold, hard cash ready to go the second you need more supplies. It's about being able to pay your bills on the spot. It's really as simple as that. Okay, but what happens when your cute little corner stand blows up and becomes a global empire? Well, the basic problem is the same, but the scale? Oh man, the scale just changes the entire game. And this is where your brain kind of has to explode a little. We're not talking about your neighbors anymore. We're talking millions of customers. We're not talking about a few bucks in a shoebox. We're talking billions with a B. But the core fear, the fundamental nightmare, it's exactly the same: running out of what you need most. For you, it's lemons. For them, it's cash. For any bank, this is the absolute number one non-negotiable golden rule. It's a promise. When you want your money, they have to give it to you right then. No questions asked. The moment they can't, trust shatters. And in banking, trust isn't just important, it's the only thing that matters. So let's go back to our lemonade stand. Things are going great. But then, one hot afternoon, someone starts a little whisper, and it starts to travel down the street. And here's the crazy part. It doesn't even have to be true. Just the fear that it might be true is enough to start a full-blown panic. And all of a sudden, your happy customers turn into a frantic mob. This is what we call a bank run, and it is a banker's worst nightmare. A tidal wave of people all demanding their money at the exact same time. And this isn't some old-timey storybook scenario. This is exactly what we saw happen to Silicon Valley Bank, where a panic that started online, a digital bank run, caused a real-world collapse. And that specific danger, that's what the industry calls liquidity risk. It's the terrifying possibility that you just won't have enough cash on hand to pay everyone who comes asking for it right when they're asking. It's the risk that the rumor becomes reality. So how on earth do you stop this from happening? How do banks brace for that worst-case scenario? Well, they've got a whole toolkit for this stuff, a sort of financial first aid kit designed to keep the lemonade flowing no matter what. First thing in the kit? Cash reserves. This is the most obvious one. It's literally a giant pile of cash and other things that you can sell super, super fast, like government bonds. Think of it as your emergency stash, your break glass in case of panic fund. Next up is something with a really fancy name: asset liability management. But forget the jargon. It just means you're smart about timing. You wouldn't schedule a massive, expensive delivery of sugar on a day when it's pouring rain and you know you're going to sell 0 cups of lemonade, right? It's just about making sure the money coming in lines up with the money going out. It's all about timing. And then there's my personal favorite: stress testing. This is basically the bank's fire drill. They literally invent financial nightmares. They pretend a market crashed, a huge rumor spread, and a competitor opened up next door, all on the same day, just to run the numbers and see if their lemonade stand would actually survive the chaos. Now, these safety measures are so incredibly important that they're not just, good ideas. They are the law. After the huge financial meltdown back in 2008, regulators all over the world got together and said, never again. It was time to write a much, much stricter rulebook. And that new rulebook is called Basel III. The whole point of it is to make the entire global banking system tougher, more resilient, and to stop that terrifying domino effect we saw in 2008 from ever happening again. It's about strengthening the whole financial food chain. One of the superstar rules in this new book is called the Liquidity Coverage Ratio, or LCR. So what is it? It's a simple but tough rule. Every bank must have enough high-quality, easy-to-sell assets to survive a massive 30-day-long panic, all on its own. And that number, 30 days, is absolutely key. The global rulebook says you have to be tough enough to weather a full month of crisis. It's the ultimate stress test, only this one isn't a simulation. It's a requirement. And look, the thinking behind all this is crystal clear. The goal is to build a system that can take a punch. It's about protecting the whole economy from another devastating crisis and making sure things stay stable for all of us. Okay, so we've got banks, lemonade stands, global regulations, but let's bring it all home. Why should any of this actually matter to you? The answer? You should care a lot, because this whole complicated system is what lets you sleep at night, financially speaking. At the end of the day, good liquidity management is what keeps your savings safe. It's the reason you can walk up to an ATM or tap your app and know your money will be there. It's the bedrock of trust that our entire economy is built on. And maybe the biggest thing, it's what prevents one failing bank from starting a chain reaction that could pull the whole system down with it. Which leaves us with one last big question to think about.
We live in a world of instant payments and digital banking now. A bank run doesn't look like people lining up down the block anymore. It looks like millions of people tapping a button on their phones in the span of a few minutes. So, are the rules we built to fight the last crisis fast enough to stop the next one? Something to think about. Thanks for tuning in.